Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And here we're going to talk about a topic that is probably on a lot of investors' mind in the moment, which is hedging a market correction, hedging your portfolio against a market correction and the best practices around that. So let's go ahead and get started. But before we do, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we are going to use as examples for today. Now, from my perspective, whenever we talk about hedging a portfolio, the goal of this session is not to say now is the time to hedge your portfolio. The goal is to learn the skills required to manage a portfolio hedge, because typically you need a portfolio hedge when the market is literally on fire. And this is really where we tend to be emotional, we tend to panic, and we make bad decisions when we are emotional and we're panicking, the markets are selling off. So it's really important that we spend the time and hone our skills and learn now and practice, so that if and when we need this, we are drilled, if you will, in terms of the best practices. So we'll start off by taking a look at the market outlook and seeing where the markets currently sit from the Canadian markets. They actually look fairly strong. I don't necessarily think now is the time to look at buying puts, but most importantly, what we want to understand is if you do need to buy a put or need to hedge your portfolio, what are the different strategies that you can utilize in a recession or in a market sell-off? Then we'll talk a little bit about a portfolio hedging strategy and the different stages of a market correction. It's important to understand market tops, market sell-offs, and kind of the capitulation here at the very bottom, and then talk a little bit about your optimal portfolio hedges. And we're going to go through some examples here with Q&A so that you can understand how to utilize this in the current market conditions. But I want you to be able to walk away from today's session with a clear understanding as to how you can efficiently hedge your portfolio against a major market correction. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and we're going to use a series of slides as well as the OptionsPlay tool to help you model your portfolio against a downside correction and see how different types of market hedges perform to offset some of the losses that you may see in your portfolio. So let's start off by taking a look at the TSX 60. This is XIU. And what you see here for XIU is that it's on a very clear uptrend here, a small decline here over the past few weeks. But as you can see, actually seeing quite a bit of strength here over the past couple of days, which is a pretty big departure from what we're seeing in the S&P 500 in the US, where we're seeing a lot more weakness here, reaching towards these lows. XIU significantly stronger, partially on the back of mining and the back of oil stocks, pushing these markets higher here versus the S&P 500. Canadian markets substantially stronger. As you can see, the daily momentum has actually turned back positive here versus on the S&P 500, momentum still remains negative. So when we talk about portfolio hedges, you really have a few different options. And the first option that you should always consider is what we call a perfect hedge. Before you think about buying put options, before you think about using derivatives, before you think about anything, the first thing you should think about is what we call a perfect hedge. That's moving your assets to cash and then reinvesting it later once you feel that the correction is over. And for certain portions of your portfolio, this is something that I always advocate for. It's not available to every part of your portfolio, but there's likely some parts of your portfolio where you're comfortable selling them into cash and then hoping to reinvest it later after the correction is over. Like I said, not everyone wants to move to cash. You might want to keep your money at work. So what you can do is think about reallocating to more defensive sectors, such as fixed income markets. Whether you're looking at treasury bonds or investment grade type bonds, you can also look at defensive sectors or maybe stable dividend type stocks, or even something less correlated like gold, Bitcoin, all the other different things that you can potentially diversify your holdings into outside of the current holdings that you have that you're concerned about a pullback. And only after you've exhausted option number 1 and option number 2, you may still have some holdings where you want to remain invested. Whether it's because you don't want to sell it because of capital gains, you don't want to sell it because you rely on the dividends for income, or for whatever other reason you want to hold on to those holdings, but you're concerned about a market pullback. Only for those assets should you consider looking at what we call a portfolio hedge, which is buying a put option to protect your portfolio. And this is really only something you should consider if you believe that the correction that the market is about to experience will be greater than 5%. So either you own stocks or ETFs that you do not wish to sell any of the holdings. That is the only time you should use a portfolio hedge. So let's say you have a $100,000 portfolio, maybe 20% of it you're willing to move to cash, 40% of it, or 40,000 you're willing to reallocate into more defensive assets, and you have $40,000 left of assets that you do not want to move into cash or to redeploy into other assets. So you want to only buy the hedge for that portion of your portfolio. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Perfect. Okay, so, and I'm going to talk a little bit about why you want to take the other two options first. And it really comes down to, let's first explain what a portfolio hedge is. The best analogy that I can think of is really think of it like an insurance policy for your portfolio during a correction. And what you're doing is you're effectively buying a put option on some kind of broad-based index, either an ETF or an index. And what you're trying to do is you're trying to have the profits from the puts offsets some of the portfolio losses that you actually experience in your portfolio. And this is going to create what we call an imperfect partial hedge, meaning you're not going to be able to hedge dollar for dollar. You're going to hedge part of the exposure. And really the thing that you have to remember, if there's nothing else that you remember from this session, is that buying puts on your portfolio is extremely expensive. It's kind of like trying to buy protection or insurance on your house while it's on fire already. It's if you try to, a lot of, I get a lot of questions from investors asking, well, why not just always buy protection? The same way you buy insurance on your house or your car. And the reason for it is because it's super expensive. You can't afford to buy puts all the time on your portfolio. If you did, you're going to have a very large drag on your portfolio from constant hedging. You're basically going to give up all upside in exchange for purchasing your downside protection. And there's no point in being invested if you don't have that upside. So it really is something as a strategy that requires active management and requires a bit of timing. And that's what we're actually going to spend quite a bit of time today, is talking about, how do you actively manage and how do you kind of time a market hedge? Does that make sense? Please type 2 into the chat window if that makes sense to you. Puts are expensive. That's the most important thing that you want to remember. And it's so expensive that you have to be very critical and very exact as to when you go about buying puts. You don't just go out there and buy puts whenever you think the markets might be correcting. So let's talk a little bit about the timing and kind of the phases, if you will, of a market sell-off. Okay, so first we'll talk about a market top. And before we kind of go into, what to look for in a market top, I want to talk about the statistics, right? We looked at 1 month decline since 2000. And out of the 247 months that we looked at, the number of times that we had a greater than 3% decline, these are all greater than, just to be clear. So greater than 3%, greater than 5%, and greater than 10%. Greater than 3% declines happened 42 times, which is about 17% of the time. So 3% is not a big decline, right? So 3% decline happens 17% of the time, which is actually a pretty small statistic. That's less than 1/5 of the time we get declines do we see a decline greater than 3%. A greater than 5%, as you start to see, now we have about a 12%. That's about 1 in 10 chance of having a decline greater than 5%. That means you have about a 90% chance that when markets accelerate to the downside, they don't accelerate by much more than 5%. And then when you look at how many declines greater than 10%, less than 2% of the time do we see declines greater than 10% in a month. So this really just hopefully helps put into context how infrequently you really need a portfolio hedge. About maybe 1/10 of the time, you may perhaps need a portfolio hedge. So 90% of the time that you think you might need one. You're probably not going to need one. And that's why it's so important that you don't go out there and just buy puts every single time you think the market has topped. But what you do instead is that you look for the signs of a market top. And the signs of the market top in itself does not tell you anything about how far the markets are going to fall. But market tops, whether they fall a couple of percentage points and start moving higher again, or if they sell 30% off, generally speaking, all look the same. So just identifying a market top in itself is not a good reason to go out there and buy puts. Does that make sense? Please type 3 into the chat window if that makes sense to you. But what you should be doing during identifying a market top is looking to sell cover calls and credit spreads, for example, to collect premium, because buying puts are going to be expensive, right? So when you're buying a put, it's like paying the insurance company for protection. Well, what you can do is when you've identified a market top, you can sort of be that insurance company by selling premium, and you can do that in the form of a cover call or a cash secured put. A cover call or a credit spread. And what you generally want to look out for are signs of what we call market exhaustion or market overbought conditions, right? So whether you like to use momentum indicators to determine a market is overbought, or if you like to use divergence indicators, a divergence is very popular, where you see the price action is making a higher high, but momentum is no longer making a higher high. Those are some of the telltale signs that we're near a market top. And you don't want to, when you see these types of patterns, go out there and buy puts, because 90% of the time you're not going to need them, or 90% of the time those puts will expire worthless. And those 9 out of 10 times that they expire worthless is going to offset any gains that you get from that 1 out of 10 times where you do really need those puts. So what you want to do is that 10 out of 10 times when you identify this, you want to sell cover calls on the equity positions that you have. You want to think about selling perhaps credit spreads if you don't own 100 shares of a stock. These are ways that you can be the insurance company and collect premium, so that when you do need to buy puts, you have some premium that you've collected that you can utilize to purchase those puts. Does that make sense? Please type 4 into the chat window if that makes sense to you. So let's talk a little bit about a correction phase. Like what actually justifies the need to go out there and buy protection? And this is really where we look at certain types of market fear indicators or panic indicators. And the VIX is a pretty good one. But the VIX, as many of you know, is a very volatile indicator in itself. It's hard to know exactly using the VIX when you want to hedge a portfolio, or when the market is really truly in a panic state. So this is, here's what I was showing you before, right? This was the February 2020 sell-off. Basically, this was, I believe, February 19th or so. We sold off at February 19th, and I think the bottom here was March 20th, maybe March 19th, somewhere around there. So basically a full month, if you will, of a decline. This was about a 30-35% decline, depending on what market you were trading. And what you see here in what we use here in terms of VIX is not just the VIX. The VIX is an expression of the S&P 500's implied volatility going 30 days out. But the VIX also has a term structure. You can have a 30-day VIX. You can also have a 90-day VIX. So there's a VIX and there's a 3-month VIX. In the same way we use the implied volatility, and you can use XIU as well. If you want to look at the implied volatilities of XIU, you can do the same thing. But what you look at is the implied volatility of the 30-day option versus the 90-day option. Most of the time, the 90-day option will be higher in terms of implied volatility than 30 days out, because there's always more uncertainty, if you will, 90 days out than there are 30 days out. However, in times of market stress, and things are kind of on fire and everyone's panicking, what happens is you get the reverse. The front month VIX, the 30-day VIX, or the 30-day XIU implied volatility will be higher than the 90-day XIU implied volatility. And when you get this contango, or what we call contango in terms of the term structure, basically you see that the 3-month VIX, and you can we look at the ratio of the 3-month VIX versus the front month VIX. As you can see, when it declines below 1, that means the 3-month VIX is higher than the front month VIX. And I'm sorry, when the front month VIX is higher than the 3-month VIX, this ratio is less than 1. And that tells us the market has entered a bit of a state of panic. And just to give you a reference point in terms of this coronavirus sell-off, that happened on February 21st, basically 2 days after the market had topped. Remember, this was February 19th. So 2 days later, 1, 2, that red candle that you see right there, that was the day when the market entered a state of panic. So as you can see, you would have been able to catch most of this to the downside using this type of indicator. Meaning you don't wait, you wait until that happens before you go out there and buy puts. And you can go back and see, pullbacks like this. And you'll see that in none of these pullbacks does the VIX or the VIX term structure go into contango. They always stay it's in contango and goes into backwardation. So normally it stays in contango and rarely does it go into backwardation. And when we see that backwardation, that is usually a good sign that the markets are in a state of panic. And again, doesn't happen very often. So when the ratio falls below 1, that tells us that markets are effectively on fire, and that is when you want to buy puts. And for those of you that are, I would say, have a good understanding of kind of options pricing, a lot of times I'll get a question from viewers saying, well, puts are really expensive if you wait until then. And you're absolutely right. They are expensive. And that's why I told you in step 1, whenever you identify a market top, 9 out of 10 times that premium will go towards not purchasing a put. But 1 out of those 10 times when the markets does sell off, you're going to use all that premium that you've collected from selling cover calls, and you're going to use that to go and buy puts. It may not cover the full protection of the put option, but you have some premium that you've collected from your cover calls that's now going to go to pay for the puts. And because 9 out of 10 times you don't need it, don't go out there and buy puts when things are cheap, because 9 out of 10 times you're not going to use it. Only buy it when you need it. It's going to be expensive, but that's why you want to sell call options prior so that you have the premium to pay for it. Does that make sense? Please type 5 into the chat window if that makes sense to you. Perfect. Okay, now the last step. When do you get out of a hedge? And this is really where volatility also is a very good indicator, but also for those of you that may not be as familiar with volatility, perhaps you're a bit more familiar with technical indicators. Both of them, they work the same way. Basically, when we identify market tops where we make higher highs in price, but no longer makes higher highs in momentum, that's a good sign that we're near a market top. But, again, negative divergence doesn't tell us that the markets are going to sell off 35%. You need some external catalyst in order for that to happen. Well, same thing happens at market bottoms. As you can see, as we continue to make lower lows in price, momentum is actually moving the opposite direction. It's actually continuing to move higher. This tells us that the sell-off is decelerating, that we're near a bottom, and that is also some of the indicators that you can use to start looking at when should I sell the put option that I've purchased. So you purchased a put option here on February 19th, and maybe you're unlikely going to catch the very bottom, but maybe, a few days into the sell-off where you're seeing towards the bottom that we keep making lower lows, but as you can see, momentum is no longer making lower lows. That's a good sign that, hey, perhaps it's time for me to start selling the put option at a profit and getting out of my hedge. And like I said, likely you're not going to get out at the very bottom. You might even be a little bit late, but that's okay. The goal is to catch as much of this as possible, but also not buy too early, meaning not buying puts here, not buying puts here, but buying puts only here and then getting out somewhere around here by looking at momentum. So momentum is one place that you can look. Another place you can also look is VIX. So if you look at the orange line is the VIX over XIU. And what you see here is that the VIX peaked back here. It peaked, if I'm not mistaken, a full 7 days before the market bottom. So as you can see, 1, 2, 3, 4, 5, 6, I think 7 is when the market actually bottomed here. So basically what you see is that the VIX will start to continue to move lower despite prices continue to move lower. So when you get this, VIX is normally inversely correlated to price, right? So as price declines, VIX increases. But at some point near the bottom, what you start to see is that the price will start declining and VIX will also decline. That's a good sign that we're near a market bottom. So those are the hallmarks, if you will, that you want to look for at a market top. When you want to think about initiating a sell-off or a put option, a hedge, and then when do you want to take off the hedge? And this is all designed to hopefully so that you only have a hedge during the times that you need and you're not paying for premium that you don't need. Does that make sense? Please type 6 into the chat window if that makes sense to you. Perfect. Okay, so let's talk about which puts do you actually buy. So this really depends on kind of the size of the correction that you're concerned about. You can hedge smaller pullbacks. You know, for example, the pullback that we've seen in the markets here over the past month or so, you can hedge it. But for those you want to use very short dated options, 1 to 2 weeks out, you're trying to maximize gamma. You're not expecting the markets to fall apart like you did back in the day. And you're basically trying to hedge a 3 to 5% pullback here in the broader markets. But if let's say the markets are starting to correct similar to what we saw back in February of 2020, and you're concerned that, hey, things are really hitting the fan, maybe this could happen in a month from now. Maybe we find that the Evergrande issue in China is much bigger than we thought, and it's another Lehman Brothers type event, right? I'm not saying it is, but let's just say that happens, and you start to see markets go into panic, and you're thinking about a larger pullback. That's when you want to use about 2 month options to minimize time decay, because you're going to be in those options for a longer amount of time. You want to make sure each day that you're holding on to that put, you're not giving up too much in terms of time premium. So in order to do that, you have to buy a longer dated option. So depending on whether you're concerned about a short-term pullback or a much, much larger pullback, you want to use anywhere from a short-dated option versus a relatively longer-dated option. And then when you're trying to choose strike prices, you have 2 possible choices. You have trying to hedge against what we call a major downside correction, or I call it catastrophic insurance, if you will, just like an insurance policy. You can choose what type of coverage you want. Well, when you buy a put option, choosing your strike price basically chooses what kind of coverage do you want. You can either buy a catastrophic insurance or you can buy comprehensive insurance. Catastrophic insurance will only protect you if there's a major downside correction. Comprehensive insurance will effectively protect you in any downside protection. So if you're looking for catastrophic, out of the money options, they're going to be relatively cheap, 1 to 3% of your portfolio value, versus a comprehensive insurance, and in the money option will cost more, about 3 to 5% of your total portfolio value. So I think the best way to really learn this is to go through a real example. So let's just bring into our platform, and let's take a look at using, we're going to use XIU as a portfolio, and I'm going to show you how to set up a portfolio to hedge, to look at and analyze a hedge on your portfolio. So we're going to use XIU as a proxy for a Canadian portfolio. And what we're going to do is we're going to modify the other 2 strategies to be a long put. Okay, so we're going to use 2 different long puts to compare next to each other. So we'll use December for both of them. And one will use a $32 put and one will use a $30 put. XIU is currently trading at $31.23. And what I'm going to compare is looking at a portfolio, and I'm going to use XIU as a proxy for my portfolio. And I'm going to hedge it with 2 different possible hedges: a catastrophic insurance and more of a comprehensive insurance. And in order for this to look like my portfolio, I'm going to use our risk and investment calculator, which is the 3rd button here on the bottom of your screen. And you can type in your portfolio into this tab, I want to invest. So let's say you have a $40,000 equity position that you're looking to hedge, right? Maybe you have a $100,000 portfolio, but but you move 20,000 into cash, you move 40,000 into more defensive assets, and let's say you have an $80,000 exposure left in equities, right? So what you can do is you can say, I have $80,000 to invest. And what this will do is it will mimic an $80,000 portfolio, which is 2,560 shares of XIU. And then this will hedge it with 26 contracts of a catastrophic insurance and comprehensive, and 26 contracts of the comprehensive insurance. And now that I think about it, you know what? I'm just going to use $100,000 portfolio for nice round numbers, just so it's easier for everyone to see the numbers, right? So I have a $100,000 portfolio that I'm hedging. The catastrophic insurance costs $1,568. The comprehensive insurance costs $4,224. So one cost about 1.5%. One costs a little over 4% of my total portfolio value in order to hedge. And I generally tend to see a lot of traders when they're trading, when they're looking at a hedge, they'll usually gravitate towards this type of strategy because it's cheap. A lot of, we all want to buy protection, but we don't want to pay a lot. So you get what you pay for. And I want to show you using the P&L simulator how this actually performs based on the different views that you have in the markets. So right now, in my opinion, it's not the best time to look at it, but maybe you're the type of investor and you're thinking that, this is a head and shoulders top. This is going to start forming debt to the downside. I think they're going to pull back here. So I'm concerned that this is going to start pulling back. So what if this starts to pull back a little bit? It fills that gap, 30-60. Let's take a look at that, 30-60, if it fills that gap. So here, if the market basically corrects about 2%, I would lose about $2,000 from my equity portfolio. And what I'll do is I'll make back about $256 on my comprehensive insurance. Again, because comprehensive insurance gives you coverage at all times, even a small 2% drop, yes, it costs almost 3 times as much, but it gives me protection. I'm paying for that protection. I'm going to get that protection. So even a 2% drop, I'm going to make some of my losses back with my comprehensive insurance. So the stock market's only dropped 2% by December. I make some of my premium back versus if I bought the catastrophic insurance, not only do I lose my $2,000, I lose an additional $1,500 because the catastrophic insurance that I paid for was useless. The market didn't have a big drop, so I lose the 100% of the premium that I pay for the coverage that I want. So it's like buying catastrophic insurance and only getting into a minor fender bender. It doesn't cover it. So you not only do you have to pay the premium on the insurance, you also have to pay for the cost of the fender bender. That's kind of the best analogy that I can come up with. Okay. Does that make sense? Please type 7 into the chat window if that makes sense to you. And let's say the markets do start to drop a little bit more. Let's say it goes to $30.30, right? Maybe it completes this head and shoulder pattern and gets back to the neckline. So now I've lost $3,000 and now I've made $1,200 back from my comprehensive insurance. My catastrophic insurance still hasn't kicked in. So not only have I lost $3,000, I have to lose an additional $1,500 on the premium versus losing $3,000 and getting about $1,200 back in my comprehensive insurance. And you can keep using this tool to see exactly how far does the market have to go. So if let's say the market now dropped 5%, right? 5%. Now I've lost $5,000 in my portfolio, but I've made $3,200 back. So it's really giving me quite a bit of protection at this point. I'm basically down about $1,800 net between the $5,000 that I've lost and the $3,200 that I've recuperated from my put option. So now I'm only down about 1.8% versus the 5% of my portfolio, versus the catastrophic insurance starts to kick in, is starting to do something, but I'm still losing money. I'm still losing an additional $500 in addition to the $5,000 that I've lost in my portfolio. So as you can see, this is really how you can start looking at what type of coverage you get. So let's look at a 10% move here to the downside, right? A 10% move, I've lost $10,000 in my portfolio. I've gained $8,100 back, which is again, I'm only net down about 1.8%. So the catastrophic insurance protects me no matter how much the market goes down now. I'm only going to be down about 1.8%. My catastrophic insurance will kick in basically 1-to-1 at this point. So for every dollar I lose in my portfolio, I'm going to gain $1 back from my put option. And no matter how far the markets go down, I'm protected where I only lose about $1,800 of my portfolio. And at this point, at 10% down, your catastrophic insurance also starts to kick in, right? So I've lost $10,000 and now I've made about $4,400 back. So that means that I've lost about 5.5% of my portfolio. So if the market's going lower and lower and lower, I'm going to see that I'm always going to lose no more than about 5.5% of my total portfolio value. And this is really how you can start comparing different strategies side by side, trying different strike price, trying different scenarios, whether the stock moves a little bit lower, in a short amount of time, or if it moves or the markets move down in a quick amount of time. And also you should look at what happens if the markets move higher, right? How much upside do I give up? Because you're going to give up more upside with the comprehensive insurance as well. Because if the markets keep moving higher, here I've made $8,000. But remember, I paid $1,500 in premium, so I have to give up about $1,500 of my gains to the upside. With my comprehensive insurance, I have to give up $4,200 in upside because that's how much I paid for the comprehensive insurance. The more premium I pay, the more I risk, the more upside that I'm giving up here to the upside. So this is really where you want to make sure that you understand the difference between the catastrophic versus comprehensive insurance, and making sure that you understand how to analyze both strategies. One is not better than the other. It's just a matter of what type of protection do you need and how much are you willing to pay for it. Just like an insurance policy, there's no right or wrong in terms of which insurance policy you buy. It just depends on how much you want to pay and what type of coverage do you want. So with that, just a quick summary of what we discussed here today. Remember, constant hedging is not cost efficient. And this is one of the few times in life that I really think it's better to be late than early. Effectively, only buying insurance when your house is already on fire, because 9 out of 10 times when there's smoke, it doesn't turn into a fire. So if you just go out there and buy insurance every single time your smoke alarm goes off, guess what? You're going to be paying for a lot of insurance that you don't need. So kind of wait until the market gets on fire, but you can do a lot of preparation. Every single time you see smoke, start selling insurance, start selling cover calls, start selling those out of the money call options. You're going to be able to collect premium. And 9 out of 10 times, that premium, you're just going to get to keep, and you're not going to need it to buy those puts. 1 out of 10 times, when that smoke does turn into a fire, that's when you want to go out there and buy puts. And in the meantime, sell cover calls, sell credit spreads whenever you find yourself that you're no longer bullish on the markets. And remember, not bullish is not the same as being bearish. You can be not bullish, but also not being bearish. So this is really what you want to do. Collect those out of the money call options, sell those, collect that premium so that you can buy those puts. And then when you're thinking about buying puts, the two things you want to think about is in the money puts provide better overall protection. Out of the money puts are cheaper, will provide catastrophic protection. So think about those two different scenarios. What type of protection do you look for, and figuring out what type of premium and what type of protection you want to pay for. With that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of protecting your portfolio against a market correction and the different phases that happen, how you want to react within each phase, and doing the preparation work now, spending the time to research and learn these things now. Because when markets panic, trust me, it's difficult to learn on the fly when the markets are selling off that quickly. You don't want to be panicking and learning at the same time. You want to be prepared now so that when markets panic, you are prepared for this, for buying puts on your portfolio. With that, that covers what I wanted to share with you here today. At this point, what I'll do is I'll open this up for Q&A, and I will try to answer as many questions as I have time for here before I jump off. So you can type your questions in the Q&A section, and I will try to answer as many questions as possible. Stan says, suppose you subsidize long protective puts with short out of the money calls. This is a good strategy. You prefer to hold your position in the underlying stock. So Stan, it's exactly what I'm proposing, is selling out of the money calls. So selling cover calls on the stock positions that you own to subsidize a long protective puts. You want to do it as soon as you find yourself that you're no longer bullish on the markets, when you see types of exhaustion, when you see markets are reaching overbought conditions, those are the best times to start selling cover calls. And 9 out of 10 times, you're not going to end up needing that premium to buy a protective put. But that 1 out of 10 times when you do need it, that's the premium that you use to go and pay for those that protective put. There's another question here is which momentum indicators generally preferred? I will tell you this, there's no momentum indicator that's necessarily better than the other. They all measure the same thing. They all measure momentum. They're slightly different calculations. So it really doesn't matter which momentum indicator you use. I can pull up probably 10 different momentum indicators in the chart that I showed you. And I would bet 10 out of 10 of them will show you that negative divergence that I was showing you. Whether you're looking at, just to kind of give you a quick snapshot here. Let's say I bring up, let's look at like RSI, for example, here. So notice how recently XIU made a higher high, but momentum did not confirm that higher high. That's an example of some exhaustion. We see the same thing here. Market made a higher high, momentum did not make a higher high. These are all signs of exhaustion. And, that doesn't mean that it leads to a dramatic sell-off, but, those are the times that you want to start selling cover calls. Now, if I use MACD, will I see the same negative divergence? I bet I probably would. As you can see here, higher highs in price, MACD move lower, higher high in price, MACD move lower. So, it really doesn't matter, in my opinion, which one you use. You can pick any of these. They all basically do pretty much the same thing. William % R, this one, William % R is one that I haven't used very much. It looks like that might be bounded. The bounded ones are a little bit more difficult to find negative divergence. So the unbounded ones like commodity channel index, as you can see, higher highs in price, really haven't seen a lot of movement here in the commodity channel index here to the upside, but pretty much all of the indicators will give you that type of signal. Are we in a correction now? I certainly don't think so. We are just, less than 1% away, less than 1% away from the all-time highs. We're well off the lows. So no, I would not call this a correction, in my opinion. Any other questions? When you are not bullish and wanting to write cover calls, do you prefer short-term or long-term calls? Generally, the sweet spot for cover calls is about 30 to 45 days out. You generally want to use 30 to 45 days out as cover calls. You don't want to go too far out, and you don't want to go too short. Any other questions? Jeanette and Michelle, you're very welcome. What is the 30-day VIX telling us? 30-day VIX just tells you the implied volatility of the 30-day SPX option, so the S&P 500 options. But you can also look at, for example, XIU implied volatilities as well. You can look at the 30-day implied volatility for XIU versus the 90-day implied volatility. You can find it on the CBOE website, CBOE. They publish the 30-day VIX and the 90-day VIX, or what's called the VIX and the 3-month VIX. Those are the what they're typically called. Any other questions? Ken, I'm just commenting here on Canadian options here. We are not talking about US options during this session. The VIX itself does not give you any type of sentiment. The VIX is just in volatility. How volatile is the market expecting? Volatility does not have a directional view. So VIX in itself, no directional view in VIX. For individual stocks, which implied volatility should we use? Well, generally speaking, most investors tend to use the 30-day volatility as a general sense for whether implied volatility is cheap or expensive. But if you find yourself mostly trading 90-day options, then you should use 90-day implied volatility. So use the volatility of the options that you're trading. It's just that most traders tend to trade options that are about 1 to 2 months out. That's why the 30-day is most popular, and that's why the VIX, is the 30-day implied volatility. When we sell cover calls, do we have to pay attention to delta? Yes. So whenever you're selling cover calls, you always want to use delta-based approach to selling cover calls. I use about a 15 delta, 20 delta, generally speaking, for selling cover calls, because I want to give my stock plenty of upside. I don't want to give up upside in exchange for an extra 30, 50 cents in income. That's not worth it. Many times I see traders, they'll collect as much income as possible. They're thinking that if I can get an extra 50 cents, that'll be great. But what they don't realize is they're giving up $4 or $5 to the upside by collecting that extra 50 cents. That's not worth it in the long run. You're going to give up more in the upside than you're collecting in terms of income. So use that far out of the money call option. 15 to 20 deltas is usually a good starting point for cover calls. Can you do spreads on the VIX? You can trade spreads on the VIX, yes. 3-month VIX is not usually available daily. Where do I find it? It is available daily. You can find it on the SIBO website. You can also find it on TradingView. Most charting packages have the 3-month VIX. Any other questions? If there are no other questions, I just want to thank everyone for taking the time out here this afternoon. I hope that this was helpful in giving you a better understanding as to how to be prepared for the next market sell-off. We are approaching some trickier times with, what's happening overseas, and perhaps we could see some, central banks lift rates a little quicker than expected because of inflation. That is the type of catalyst that could drive markets lower here. Those are the types of things that we want to be prepared for. Not saying they're going to happen, but those are the types of scenarios that could cause you to need to buy put protection. So now is the time to prepare. Now is the time to learn, so that when that day comes, you're prepared and you know what to do. With that, thank you so much. Have a great trading day, and I'll see you guys here next time.